Good afternoon, everyone. Welcome to our Iowa Department of Revenue Iowa SourceLink webinar on common tax issues. As everyone is signing in here this afternoon, we'll do just a little bit of quick introductions and then get underway. My name is Patrick Lintzman. I work at the University of Northern Iowa and work with the Iowa SourceLink platform, which is a partnership with the Iowa Economic Development Authority, where we connect businesses with information all across Iowa. And we work to bring you sessions like these today with the Iowa Department of Revenue. Joining us today, we've got staff from the UNI team and SourceLink team. Kyle Kugler here to help facilitate, and Sophie is in the background in the University of Northern Iowa account, and she'll be helping out posting links and different things throughout today's webinar. Our topic today is common tax issues, and we're going to work really hard to keep it to that topic. I know there's lots of other things happening, especially with the new portal and things, but we want to try and keep this one as directed as possible for today's common tax issues. Thank you, everyone, for joining us. We're looking forward to having you here today with us.
Awesome. Well, I'm just going to go through a couple of brief housekeeping items before we really get into it. Just a reminder, this is going to be recorded. It is currently recording right now. This recording will be available at iasourcelink.com a little bit later on in this week. You can find it there on our tax webinar page. There is a Q&A chat box down at the bottom of your screen. There you can ask your questions and we will try to answer them either within the chat, or we will be periodically stopping, answering throughout the presentation, and also at the end if we have time. Also, additionally, if you are here and you are someone who can self-report on continuing education credits, this is available to do that. SourceLink does not have actual documentation to provide you with for that specifically, but we can give you basically proof that you did attend this, and then you can self-report on that. Patrick, do you have anything additional to add to that?
Nope. Throughout that, for those of you that are going to be self-reporting, the links to the slides are going to be in the chat throughout today's session. So you can grab them there. So with that, Kurt, welcome. Kurt is a policy director for individual income tax, Department of Revenue. Go ahead and take it away.
All right. Thanks, Patrick. Thanks, Kyle. Yeah, as Patrick mentioned, I'm a certified public accountant. I'm a policy director. I'm actually the individual income tax policy director. I also oversee withholding and trust and estate tax. We've had our policy director roles for a couple of years now at the Department of Revenue, and I'll give you the contact information for the other policy directors in just a couple of minutes. Before we get started, I need to go through our disclaimer. Just to remind everybody that this presentation is intended for general education purposes only. Nothing is to be construed as legal advice. The Iowa Department of Revenue could take a contrary position in the future to the one stated in the presentation. And if you want some sort of binding guidance, we recommend that you file a petition for a declaratory order with the Department of Revenue. We do have our mission with the department, and that is to serve Iowans and support state government by collecting all taxes required by law, but no more. And the vision for the department is for Iowa to be a state where it's easy to understand and comply with the tax obligations for all Iowa tax filers. As I mentioned earlier, this is the slide for the 4 policy directors. We've been in these roles for just a little bit over 2 years. Mike Mertens handles the pass-through entities, Ben Clow, corporate income tax, and Tim Riley, sales and excise tax. If you have questions related to policy, these are the guys to reach out to and ask questions. If you have questions about a specific client or specific tax situation, it's best to reach out to the examiner that's handling the case. Or you could submit questions to our request for tax guidance page, or as I mentioned earlier, you could request a declaratory order if you want some binding guidance with the department. But policy directors are really good at responding to questions if you have any for us. Before I dig into the common errors that I'm finding, I just wanted to remind people about House File 590 and the tax preparer regulations. Most people understand that if a tax preparer prepares 10 or more tax returns and they take final responsibility for a tax return, we have rules that came into place for tax year 2020. So we're rolling into our second year right now, and I want to make sure everybody's fulfilling those education requirements if they're required for this purpose. We do have a group of individuals that are excluded. Those are licensed individuals, the certified public accountants, the licensed public accountants, attorneys, enrolled agents, fiduciaries of the states, and this is the complete list on this slide. But just a reminder that if you're required to obtain CPE, the requirement is 15 hours of continuing education. 2 of those hours have to pertain to professional ethics, and the classes need to be taken through an Internal Revenue Service approved provider, which you are sitting in a class that's being conducted by an approved provider today. You need to submit the CPE courses by February 15th. There's a link on this slide, and everybody, I believe, does get a copy of the slide presentation from today. But to prepare education forms, Form 78-012 needs to be submitted to the department. And the reason I went through all that is just to tell people some of the common errors that I found with some of the reporting that we've received so far. It seems like we've received a number of forms where the hours have been miscalculated. On the forms, there's been hours reported, but they've been totaled incorrectly, or we're having problems finding valid PTIN numbers. Some of the preparers are not completing the titles and the hours for the classes that they're taking, and others are not signing the form. So just make sure you're thorough when you complete this form and submit it to the department. We're just wanting to make sure that there's a minimum level of competency in the state for the tax return preparers. Nothing personal, but let's jump into the meat of the presentation for today. Primarily, I'm going to talk about common errors on income tax returns. I'm going to cover some of the individual income tax common errors right now. The very first link on here is going to cover the slides that I'm going to go through here shortly, if you want to review those on your own again later on. But the first thing I want to go through is the federal income tax refund, and I'm going to go ahead and click on this link. And many people are aware, if you filed a tax return for, let's say, 2019, and I filed an Iowa return and a federal return, when I prepare my 2019, when I prepare my 2020 return, I'd be required to report the federal refund that I receive in tax year 2020 because I deducted taxes on the prior year when I completed my individual income tax return. I've listed on here some of the common, or the department has listed some of the common issues we have with that. Something that jumps out at me is federal estimated tax estimates. There may be some confusion if I filed my tax return in 2019 and I applied part of my federal overpayment to estimates for 2020, and the amount of my refund was less than the full amount that was calculated on the return. You need to remember to consider those as 2 separate transactions. One, the refund portion, and then the payment that was applied to the other tax year. You're still required to report that total federal overpayment that was calculated on the federal return as a refund, and then the amount that was applied towards your 2020 estimates, you'd pick those up as a tax payment. On the screen, you can see that there's some things that we don't count as part of that federal refund. The economic impact payments or the stimulus payments, the earned income tax credit, additional child tax credits. I won't go through all those. If you were a non-resident in the prior year and you didn't receive a tax benefit from federal taxes paid, you wouldn't have to pick up this refund for this year. But generally, if you filed an Iowa and a federal return in the prior year and you received a federal refund, you need to pick up that federal tax refund on the return this year. And we do receive information from the federal government, so we do know the amount of those refunds. This next item I think is pretty cool. A number of taxpayers don't report didn't report the correct school district for the taxpayer. And I understand taxpayers move. Maybe they remember to change their address on the tax return, but they don't update the school district. And I know in the county that I'm in, I believe there's 3 different school districts that attach to Jasper County, but I'm going to click on this school district link that I have on here. And it's my understanding that Tax Mapper, it works really great on your mobile devices, and the web page is good too, but a lot of people really like the web device. And this is pretty cool. I'm going to go down and click on school district surtax. I want to find out what school district I live in. And then I'm going to call up an address, and this is the address of the Hoover building. I work 24/7, so that's really like my home. So I'm going to pretend that is for this purpose. And when I click search, it's like, voila, it magically tells me that I'm in the Des Moines Independent Community School District and the rate is 0%. So that's really cool. Again, I think everybody gets a copy of this slide deck. So the Tax Mapper, I think that's a great app to determine what school district the taxpayer is located in. The next bullet point on here is the incorrect amount of withholding. Most people don't have a problem picking up the withholding that's found on their W-2 form, but they may overlook withholding amounts that show up on the W-2 G forms. Those would be the gambling forms, the 1099 forms. Those are the ones that I believe the withholding is primarily missed. So just make sure if you do have withholding on all your W-2s, 1099s, you get those picked up just so we can match those correctly. Incorrect amount of estimates that are paid. Again, I'm going to go out and I'm going to click on this page. And with the estimate, there's not a lot of trick to that. Some people don't know what to do if they submit a payment with a 1040V form when they meant to do it on 1040S. We're really looking at all payments for this tax year. There might be confusion on whether I look at, is it the actual calendar year that I made the payments, or is it the stubs that I send in? I know the last one is due January 31st. Do I count that as a 2019 or 2020 estimate? And when you send your estimate vouchers in, those are specific to a tax year. So all 4 quarterly estimates will be considered an estimate for that tax year that's specified, like 2021, for example. And I do understand that some people, some clients might think that they paid all their estimates. They might think that they paid all their estimates on time, but you might just want to have them track it on a separate sheet, the date they paid them and the dollar amount, because sometimes those don't always match up. Health insurance deduction. I'm going to open that up for you. And with the health insurance deduction in Iowa, you're able to take an above the line deduction for health insurance. You don't have to itemize, and you're able to take 100% of the amount that's paid for health insurance premiums that are paid with post-tax dollars, amounts that are paid for supplemental health insurance. That would be like your Medicare Part D, Medicare Part D, dental insurance, and also the long-term care insurance that's paid. And we don't have the same limitations that the federal does for the long-term care insurance that's paid. You don't include the Medicare tax that's withheld on the W-2s or the premiums paid with pre-tax dollars. That would be the amount that shows up in box 12D on your W-2. In most cases, that money was already withdrawn pre-tax. You haven't paid any tax on that money for your copay, so you wouldn't get a deduction now. And then also there's some amounts that are paid for the excess advance premium tax credits and the net premium tax credits. And there's instructions on this page to tell you how to handle that. It looks like if you have an excess advance premium tax credit payment that's being made, you're able to deduct that on line 18 as another health insurance premium deduction. And then if you get an additional credit, a net premium tax credit on Schedule 3, line 8, you're required to go back and pick that up as other income on line 14 of your return. So health insurance is kind of tricky, but probably the biggest thing that we run into is taxpayers that have health insurance that's taken out pre-tax, and then they also take a health insurance deduction. Name and address, just want to make sure those are correct on the return, want to make sure that you're using your legal name and the correct street address. Sometimes that's just missed, but it is a very common error. Low income exemption, let me talk through what the confusion is on the $1,000 non-resident exemption. Okay, I'm going down now to the single taxpayer. So if you're a single taxpayer and you're a resident of the state of Iowa, if your income is $9,000 or less and you're not a dependent of another, or it looks like it's $24,000 if you're age 65 or older, you're not required to file a return in the state of Iowa. Or if you're a dependent of another, but your income is less than $5,000, you're not required to file a return. And then for all other filing statuses, you can see in this section, the amounts jump up to $13,500 and $32,000. And here's the non-resident part year resident. If I've got Iowa source income of less than $1,000, then I'm not required to file an Iowa return. And some of the confusion comes into play when the taxpayers have more than $1,000 of Iowa source income, and some taxpayers believe that these thresholds for like the single taxpayer, where it's $9,000, is only $1,000. But we just want to make sure that if you're a non-resident of the state of Iowa and you have Iowa source income of more than $1,000, you're required to file an Iowa tax return. Oops, I'm jumping ahead of myself. After the low income exemption, we've got the non-resident part year resident form, Iowa 126. Probably one of the biggest things on this is for the non-residents that have gambling income or unemployment income or K-1 income, and they don't pick that up on this return as Iowa source income when it actually is Iowa source income. And usually that's indicated on like the K-1 form, what's Iowa source income and what's not Iowa source income. For the Iowa 130 form, this is the form for the out-of-state tax credit. And actually, sometimes we have a problem with the Iowa 126 and Iowa 130 form, where a taxpayer might take a non-resident tax credit and then also try to take an out-of-state tax credit, and they're kind of double dipping when it's not appropriate. So that's probably one of the biggest problems that I run into. Otherwise, with this form, I know probably most of you use computerized systems right now, so everything works out great, but sometimes the calculation doesn't turn out correctly on this Iowa 130 form for taxpayers that prepare forms by hand. And I sure hope there's not a lot of you out there, because that would be a burden. Signatures and attachments. This is going to apply to taxpayers that file a paper return, and I'll address the attachments first. If I file a paper return and I have withholding from the W-2s, from the 1099s, maybe something that's reported on a K-1, I'm required to attach that to the tax return to show proof that there is Iowa withholding. And then part two, with the paper returns that are submitted, some people are in the habit of filing returns electronically and maybe not actually having to sign anything. They do it all electronically. But some of these returns are submitted and they have no signature at all, which isn't acceptable. And then second of all, some people don't know how to sign returns if you've got a deceased taxpayer, and that's what I've got up on the screen right now. And if you've got a deceased taxpayer, what we're going to have you do is on the line for the deceased spouse, we're going to have you indicate that you're filing as a surviving spouse. There's a box for you to check right after that indicating that the spouse is deceased. And then you're going to sign, and then you're going to enter the date of death. And then if the spouse is unable to sign, we have you go ahead and sign your spouse's name, and then you're going to follow that by, and you're going to sign your name, and you're going to indicate that you're a spouse, Then we also have instructions right here if you've got a minor child, which is real similar to the spouse signatures. Some other issues that we run into, bank account information. If you input the incorrect bank information for your refunds and you submit the return, especially electronically, there's no way for us to change that information. We need to go through the process of trying to deposit the refund, have it rejected, and then create a paper check and mail it out to you. But you might just want to go make that part of your standard procedure to go ahead and just confirm the bank account information each year, just so there isn't a burden placed on you or placed on your client. At the federal level, they do some examination work. There's some automatic checks that are done. They send out the CP 2000 notices, and at times possibly you or your clients are involved in a federal audit. And if there's adjustments that are made at the federal level, we ask that you go ahead and determine if an adjustment has to be made at the Iowa level and submit an Iowa amended return if necessary. We do get correspondence from the Internal Revenue Service, so we are notified of changes that are made, and it might save you or your client some penalty or additional interest if you make that amendment sooner rather than later. Unemployment compensation. This was kind of a big deal this past year. A number of taxpayers received the 1099-G forms for the unemployment compensation that was received. I know many taxpayers in the state of Iowa received 2 of those forms this past year. And then at the federal level, they excluded the first $10,200 of income for qualifying taxpayers if they had a modified adjusted gross income of below $150,000. So there were a number of problems this past year. The federal government advised people not to amend tax returns. They were going to make changes on their end, and the state of Iowa did exactly the same thing. And some of the issues that we ran into this past year, I think we've got most of those returns processed now, or most of the adjustments processed now. But we did have a number of taxpayers that would report the incorrect 1099-G amount. They might report more than they should have. They combined the 2 1099-G forms, or they reported the incorrect amount of federal or state withholding. They calculated the exclusions incorrectly, and then some people did submit amended tax returns after we did request that you do not do that, and that just created a little bit of additional work. But fortunately, I think we're through that now. We won't have to deal with that, I don't believe, for the 2001 tax year. Capital gain deduction. I'm going to go through this not real deep, but we do have a number of issues with the capital gain deduction. Here's a listing of all the forms that are allowed or that should be used if you're claiming the capital gain deduction. I'm not going to jump into this real deep right now because we cover it a little bit more in just a second. And this, to qualify for the capital gain deduction, there are certain sales that are eligible after January 1st of 1998, and there's different participation requirements that are required. In our rules, administrative rules, section 4038 cover the capital gain deduction. So the qualifying transactions would relate to the sale of real property, the sale of a business entity, certain livestock sales, timber, liquidation of corporations, and employee stock options. So that's generally what qualifies for the capital gain deduction. For certain sales, like the sale of real property and sale of business entities, there's a material participation requirement. And generally what we're looking for is regular, continuous, and substantial participation for 10 years or more. And I just wanted to bring up participation of others. If you've got a spouse that participated in the business with you, their participation counts when you're trying to calculate the number of hours or prove the number of hours for material participation. But activities of other family members, of other employees, of people that you consult with or contract with, they don't count as participation hours for the owner. And then there's a handful of tests to qualify, and these are all under 4038. There's some various 500-hour tests, hour tests. If you've got multiple businesses, you can meet the 500-hour test as long as you participate 100 hours or more in all the businesses. You'll note that this does exclude the rental businesses under this test. And then there's also one for maybe some of you are tax preparers. If you participate in a personal service activity, that participation requirement just drops down to 3 years. But I'm not going to dig in real deep on these, but here's some of the common errors that I find with the capital gain deduction forms. First of all, if there's capital gains that are reported on Schedule D, sometimes all those are taken as a capital gain deduction on the Iowa return, which isn't correct, because we just kind of talk through what sales may qualify for the capital gain deduction. But along that same vein, some people report stock sales when it doesn't qualify. There's certain stock sales that may qualify, but some people report all their stock sales on the capital gain deduction form, which isn't appropriate. Or you might have a business that sold all their assets and they want to exclude the gain on those, and anything that generated a capital gain like goodwill may qualify. But if they sold their personal property, like a piece of equipment that was fully depreciated and there's depreciation recapture, that's ordinary income and it's not capital, so that wouldn't qualify. And the same holds true of inventory sales. That's ordinary income, it's not capital. We have a number of protests related to self-rentals. And the common situation is I've got a business owner, they have real estate, and for tax planning purposes, they may have formed, let's say, an LLC that holds rental property, and the rental property, and then you have an operating businesses that rents the rental property from the LLC. And the LLC's only responsibility is to collect the rental checks. They have, say, a triple net lease. So the operating business pays all taxes, pays all insurance, pays all repair and maintenance. And at the time of the sale, the business owner wants to claim the participation that's happening at the operating level in the LLC, and it's just not allowed. That's probably one of the biggest issues that we do have. The rental business will have to prove that it met one of those material participation tests before the capital gain deduction is allowed. Another error that I see related to the capital gain deduction relates to the net gain reported on Schedule D. So I might sell the business and I might have a $100,000 gain from the sale of goodwill that we'll say qualifies for this purpose. And then the taxpayer plans ahead and they sell stock and they generate a loss of $50,000. So their net gain on Schedule D is $50,000. Sometimes that taxpayer will just take a capital gain deduction for the same dollar amount, $50,000, where, remember I mentioned earlier that we exclude just your normal stock sale, one that doesn't qualify for the capital gain deduction. We don't net those together. So in this situation, the taxpayer would have a net gain of $50,000 and they'd be eligible to take a capital gain deduction of $100,000. Other errors related to the capital gain deduction, quite frankly, sometimes just these Iowa 100 forms aren't submitted when they should be submitted. So if I've got multiple sales, separate sales, I need to report and include separate Iowa 100 forms. There might be a capital gain that's being passed through, say, a partnership. I need to submit a form still reporting the capital gain deduction, even though that passed through a separate entity. If you have an installment sale, every year of that installment sale, I need to include that Iowa 100 form because the department doesn't track that. So we need to be reminded, shall we say, that there's an installment sale and that gain qualifies. If taxpayers are filing married filing separately, each taxpayer must complete an Iowa 100 form for their share of the capital gain that's going to be excluded. And then one last thing is just a reminder, if you've got a capital gain deduction and you have a net operating loss, that capital gain deduction has to be added back before you calculate your NOL. You can't increase the amount of your NOL by the amount of the capital gain deduction. A few other issues related to individuals, non-reporting. We've got taxpayers that receive K-1s from partnerships, from S corporations, from trusts, and they also receive 1099 income. Maybe they're a contractor, and some of that income is just not making it to the 1040 returns. And we're matching that information. And if you do have Iowa source income, if you're a non-resident, or if you're a resident and you get a K-1 from one of these entities, you got to be picking that income up. It's a lot better that you report on the front end rather than getting a letter on the back end. Record retention. We do have compliance activity that goes on continually throughout the year. And it's the taxpayer's responsibility to have proper documentation when we request it. Generally, you're required to hold that information during the full statute of limitation period for that return, which is generally a 3-year period. If a tax return hasn't been filed, it's unlimited. The statute never starts, so the department always has the opportunity to examine those tax returns. Another common error relates to the extension of time to file. For Iowa purposes, on the income tax returns, we'll say individual income tax today, but income tax returns, if you pay in 90% of the tax due on that return by the due date of the tax return, you automatically get a 6-month extension time to file. Some taxpayers believe that if they file for an extension of time to file at the federal level, they automatically get that at the Iowa level, and that's not correct. The only way you get that extension of time to file is if you pay 90% of your tax due by the due date of your tax return, then you get the 6-month extension. Otherwise, you don't have a valid extension of time to file. Some other issues, if you got taxpayers or if you're involved with another taxpayer and they have some sort of outstanding federal debt, court debt, and they might be subject to offset, it might be worthwhile to consider using filing status for married filing separately so that your portion of your refund isn't reduced by that outstanding tax liability. We'll talk briefly about the Iowa-Illinois reciprocal agreement. Illinois is the only state that Iowa does have a reciprocal agreement with. And what this does is it would allow an Iowa taxpayer to work in Illinois, and they could complete this Illinois W-5NR form, and that would instruct that employer to just withhold Iowa income tax. And if that's my only source of income, I would only have to file an Iowa tax return. And the same thing holds true for the Illinois employee. They're working in Iowa, they complete this Iowa 44-016, and the Iowa employer would just withhold Illinois income tax. And again, if that was their only source of income, that Illinois employee would only have to file an Illinois tax return. It just makes life a little bit simpler for them. Something to keep in mind with this reciprocal agreement is that, oops, let me go back. Okay, it doesn't include gambling winnings or unemployment. I wanted to point that out because last year we did have a lot of unemployment payments that went out, and if there was withholding, the withholding would be for Iowa income tax, and that would be Iowa source income. So there would be an Iowa filing requirement this past year. Or if you had an Illinois resident that gambled in the state of Iowa and received a W-2G form, they may have a Iowa filing requirement also. But generally, if the wage is their only income, it does reduce the burden, so the taxpayer just has to file in their home state. I'm going to go through some common business-related errors right now. Iowa generally conforms with the federal tax rules right now. So in regards to businesses and their expenses, we usually just want to confirm that the expenses that are reported are ordinary and necessary in general conformance with Internal Revenue Code Section 162. Similar to the other areas on the individual income tax return, we may request documentation to prove the expenses, to prove again that they're necessary and ordinary. And when we make that request, first off, we like to get a response when we request documentation to prove an expenditure. Otherwise, if we don't get a response, we'll just deny the expense. And that's the easiest thing. And quite frankly, it's the only thing that we can do. And when we do get information, we want and we would expect the tax preparer or taxpayer to give us clean documentation. I guess I'm looking for documentation that would specifically identify what was purchased, when it was purchased, and a clear distinction on whether items that are listed are personal or whether they're business related. And if there's documentation that's related to multiple businesses, that those expenses are broken out by each of those business entities. I have seen some situations where a taxpayer is just sent in a box of invoices and essentially said, you figure it out. And quite frankly, it's not our job to figure it out. It's the taxpayer's job, to prove that they have qualifying expenses, and it would sure make our job easier if they would sort through it. Or again, a lot of those expenses will just be denied if we can't tell what's business, what's personal, and what expenses relate to which business. With vehicles, we do expect taxpayers to have the same documentation that's required at the federal level. We're looking for business logs proving personal miles, business miles that are driven. Some taxpayers might take standard mileage, and they might also try to report actual miles on a tax return, which many of you know is not allowed. That would be double dipping. But just make sure there's a good record of what of your vehicle expenses and the distinction between personal and business. Farm cash rent. Taxpayers that have a cash rent arrangement, some of those are being reported on Schedule F, and some of them seem reporting expenses that don't seem ordinary and necessary for that type of business activity, especially if their only obligation is to pay real estate tax, pay insurance, and deposit cash rent checks. So make sure that you're using the right form and make sure that the expenses are ordinary and the expenses aren't necessary. With some of the business returns, sometimes we find that the deposits don't necessarily match the income that's reported on that business income tax return. At other times, we have business returns that report expenses, but no income at all. And it seems like in a lot of those situations, they end up being taxpayers that are employees of a company, and they have expenses that seem to be related to that business, and they're really not self-employed. But just make sure that, look at the very bottom bullet point on here, that there's a profit motive behind these. Just by having expenses doesn't necessarily create a business. We utilize the same standards as the Internal Revenue Service. We're kind of looking for profit in 3 of the past 5 years on business activities. Otherwise, we might question whether there really is a profit motive related to it. On the business use of the home, we want to see a Form 8829, similar to the federal level. If you're going to take business use of the home, we want to confirm that this area is used exclusively and regularly for the business. If it's a separate structure, again, we want to make sure it's used exclusively for the business. Are you storing inventory in these storage units, and that's the only thing that you have in there? And I understand if you've got a daycare, the home doesn't have to be exclusively for the daycare. There's special rules that are related to that. But again, we generally follow the federal rules, and we just ask for certain documentation to prove that these expenses are ordinary and are necessary. With composite tax returns, an error that we discover on those, the link, I just want to see what the link is on that. With the composite return, on page 2, this is where you're going to list the non-residents. These are going to be the partners, shareholders, beneficiaries, and members. If you go to some of our other tax schools that we're attending this year, we're going to talk a little bit more about composites returns and what's going to happen in 2022. But a common error that we have on this is that taxpayers will complete, we'll say, partner information for this purpose. They're going to indicate the amount of Iowa source income for that taxpayer, and then they include all of these shareholders up here when we look for the minimum count, and we calculate the standard deduction. But you need to remember to go back to, I think it's page 2 of the instructions, page 4 of this PDF. And in this column right here, if the taxpayer has income that's below these thresholds, then they can't be included, because to be included on a composite return, you need to have income and you're required to have a tax liability. If you don't have a tax liability, you're not allowed to be included on the composite return. And the problem with including all of the shareholders on this form here is that you overstate the standard deduction amount, which reduces the tax liability incorrectly. So just make sure that all the taxpayers meet that minimum level before they're included on the composite return. With other businesses that we've examined, we found times where taxpayers have deducted wages on the tax return, but they don't have a withholding permit with the state of Iowa, and they haven't withheld any tax. And we do follow up with the taxpayers and make sure they're in compliance with any withholding requirements and also any sales tax requirements. We do look at the business industry codes to determine whether that business should be collecting and paying sales tax, and we've been doing our best to reach out to those businesses because I know everybody does want to be in compliance. The same thing with research activities credits. We do look at business activity codes for taxpayers that are claiming the research activity credit to make sure that, one, the industry makes sense. If it doesn't, we might send a letter out just requesting additional information. And then for other taxpayers that do claim the research activity credit, at times we do request documentation to prove that there is true research activities and they do qualify for that tax credit. If you do own a business and your spouse is not part owner in that business, one suggestion that we have is that if your spouse is involved in the business and might be involved with any communications with, say, the Iowa Department of Revenue, that you might want to consider authorizing them as a power of attorney so they can communicate with the department when there's questions. It's not uncommon for us to call and maybe the spouse that's not the owner might answer, they might handle the books for the business, and it's nice to have that power of attorney form up front so that we can discuss that information with them. Here's some common errors that we have related to fiduciary tax returns. I just want to cover some of those quick. A lot of these relate to fiduciary returns and the estate returns as well. But on the fiduciary returns that are filed in that first year, we do want a copy of the wills, the trust documents, and then when you're submitting the fiduciary returns, we always want a copy of the federal 1041 form as well. With the certificates of acquittance, we've been trying to get those out in 60 days, and I think actually we're beyond that right now. And we've been getting a lot of requests from tax preparers requesting a certificate of acquittance when maybe a certificate is not required. And we'll cover some of those in a little bit. And then another thing that's been slowing us down is that we've been sending out correspondence requesting additional information related to some of the 1041s, and we're not getting responses right now. And I think our option is just to make any adjustments and send out notices right now if we're not getting responses. But those are a couple things that are slowing us down, but I'll cover some other items in just a minute. If you are requesting a certificate of acquittance for the 1041 return, make sure that you mark that return as a final return, that you mark the box yes, requesting that certificate of acquittance, and then on line, I believe it's 22, make sure there's no balance due on the return. When you file the final return, all income is required to be distributed out to the beneficiaries, so there should be no income that's retained by that trust or estate, so there should be no balance due. We receive a number of returns where the return is not signed. Also, there's information that's missing when these returns are submitted. The decedent's Social Security number isn't excluded or is excluded, which makes it difficult to confirm that there's no outstanding tax liabilities for that taxpayer. Sometimes there's no probate number or the date of death is missing on that tax return. We're finding some returns are submitted with incorrect federal ID numbers. Sometimes that will happen if you have a grantor return that converts to an irrevocable return upon death. There should be 2 EIN numbers. The power of attorney is missing. There's no information that's included on that power of attorney line, or some people indicate a firm name on that power of attorney line, and that's not allowed. You can authorize an individual to be a power of attorney, but you can't authorize a whole firm. It has to be an individual. On some of the 1041 forms, there's calculation errors on the form, and I hope more and more people use electronic returns because that eliminates that error usually. And here's some of the things that are slowing down that certificate of acquittance process. Some people are requesting those certificates when there's no probate. There might be a trust, for instance, and no probate's required, but they want the certificate. And again, keep in mind that when you get a certificate of acquittance, the department is really saying that all known liabilities are paid. It's not like a get out of jail free card if some income is later discovered and there's a tax liability. It's really just indicating that all known liabilities are paid. And if the trust is not in probate, there's no return that's required. If you've got a grantor trust, those normally don't, I don't believe those ever require probate, but usually a grantor trust doesn't require one. If it's not a final return, we wouldn't issue a certificate of acquittance, or if there's a balance due, we would not request a certificate of acquittance. Again, our goal is to try to get these certificates out within 60 days whenever possible. We're hanging out over that right now, but we're doing the best that we can to get caught up. If we do request additional information, please respond as quickly as you can, because I know a lot of you have court dates coming up and you're just as anxious to get these estates closed as we are. Make sure all tax liabilities are paid in full. Those would be the liabilities for the trust or the estate and the individual as well. All tax returns have to be filed. All liabilities have to be paid before we issue that 1041 return. Make sure all the 1040s are filed. And if you've got multiple trust returns that you're submitting at one time for whatever reason, I just discovered I had a filing requirement and I've got to get 2 or 3 years worth of returns submitted. When you submit those returns, if you're doing them on paper, make sure that you have the newest return on top, the most recent one, because we'll process from whatever's on top down to the bottom. And if we start with the top one and you're wanting to get a certificate of acquittance back within 60 days, and we start working on the top going down, it might take longer. Put that most recent one on top so we process that one first, and then hopefully that'll speed up the process of getting that certificate of acquittance back out again. Fraud prevention. Fraud continues to kick along each year, And just a couple words of advice. I know a number of tax preparers are working remotely. If you do, make sure that you use some sort of multi-factor authentication when you access your network servers, just to make it a little bit more difficult for the thieves to access that information. They'd like nothing better than to gain access to your server and get a bunch of your clients' confidential information, which would be a major burden for you and your tax clients. I mean, it may make sense to compare your EFIN file. You can go to the IRS site and you can monitor returns that are filed. I'd like to recommend on a daily basis. That might be tough, but on a regular cadence, I recommend going out and comparing the number of returns that you think you filed for you or your firm with the returns that are being filed, that are being shown filed in that EFIN file, just to make sure that there's not a huge discrepancy. Otherwise, that could be an indication that there's a problem. If you're submitting returns and you're getting messages that returns are already filed, contact the Department of Revenue right away. And it's good to give us that information sooner, so that if there is identity theft, that maybe we can stop that as soon as possible. This past year, we identified 370 identity theft cases, and we curtailed refunds of $4.2 million from going out. And unfortunately, a lot of these theft claims focused on elderly and disabled individuals this past year. The IRS encouraged all individuals to file tax returns, especially for the purpose of processing the stimulus payments this past year. So unfortunately, a large number of those returns impacted elderly, impacted disabled beneficiaries, and hopefully we're past that now. And I feel sorry for anybody that was impacted by these fraudulent returns that were submitted. I want to let everybody know that on December 8th, we do have a webinar, and this relates to the electronic filing of W-2s and 1099s. This year, all of the W-2s and 1099s that have Iowa withholding need to be submitted using GovConnect Iowa. And so yeah, go ahead and register for this seminar. I've got the link at the bottom of this page, and I think that could be good information for you. We're just slowly rolling into our new tax system, and we're excited. I think it's going to be a win-win for both of us. We do have some growing pains, so I mean, just work with us a little bit. I think in the end, once you have all your clients set up in the new portal, it's going to be a good thing. But just anytime that you have a conversion, there just seems to be some pains, and I think if we work together, we can get through this. If you haven't subscribed to updates in the Department of Revenue, make sure you go out and do that. Then you can get timely updates on, hey, webinars that you might want to go see. Otherwise, if we do have news releases, I think you probably want to stay current on those. It would benefit you, it would benefit your clients if you do have clients. And here's all the information or topics that you'll receive updates on if you do subscribe to our page. And with that, I get down to the very end, and I did leave just a few minutes anyway for a couple questions. Patrick, do you have any good ones for me?
Yeah, Kurt, no, great job. Thank you for going through that presentation. A lot of great information there. On that link for the next webinar, Sophie did post it in the chat, so go ahead and sign up for that. First one in here we got, is there a quote unquote simple way for a taxpayer to check the amount of estimated payments that have been made?
If you use the e-file and pay system in the previous year, you could go look at the history of payments that were made. Otherwise, when we go into for individual income tax, that's not going to occur until rollout 3, which will be in 2023. So the easiest way is to use the e-file and pay, which is now going to be GovConnect Iowa, and make your payments electronically from there. Then you could track those payments.
Gotcha. There are a couple questions about the 2021 Form 1040. when that would potentially be available for people to look at the draft or version.
The forms team are finishing up right now. We're kind of down to the expanded online instructions, which is a big task. We hope to have that done by the first part of December. And we've got a number of the forms out to the software vendors right now to give them an opportunity to test all the forms and ask questions. And as soon as we have that done, we'll release the forms. But I've got a feeling it'll probably be late December before that'll happen.
Okay, sounds good. We did have a question, maybe more general. If you know that someone is not reporting all their taxes and has some cash income, how would someone go about reporting that? And is there a way to do it anonymously?
Oh, gosh, that's a good question. I should have a pat answer for something like that. I'm not asked that every day. We do have a fraud unit, and I might have to go ask the proper way to make that submission. I don't know if you just called in on the regular tax. I believe you'd probably call in the taxpayer service line, and they could transfer you over to our fraud unit. But I can't answer that. I apologize for that, but that's a very good question.
Yeah, no, that's okay. Let's see. So, question just came in here from Dave. Looking about health insurance deductions. We had a few other questions about health insurance deductions. What about premiums for cancer or catastrophic illness policy premiums, and how are those going to be handled?
And if you're paying for health insurance, those expenses would qualify. If you're paying for a policy that pays you so much per day for an illness, and I think some of you were, or some of the companies, I'm trying to think of one right off the top of my head where I pay, you guys have seen the commercials where I pay in, and then if I'm sick, I get X number of dollars a day, $200 a day while I'm sick or whatever it is while I'm going through treatments. That's not health insurance. Those plans don't cover my illness. It's kind of like a savings account where it pays me so much per day when I do get sick, which is in contrast to an actual health insurance plan where I pay, and then when I get sick, it covers my actual medical bills. So I don't know if that answers the question, Patrick, but it depends on the plan. It actually has to be a health insurance plan.
Okay. Going back to a little bit of I believe it's in the capital gains section, say you have an installment sale and no money for some reason is received in a year, and then a double payment is made at the beginning of the next year. Does no activity get reported in the non-payment year?
Yeah, in the non-payment year, you're required to complete one of the Iowa 100 forms in the years that you're taking the capital gain deduction to substantiate that deduction. If you don't receive a payment in that year, there's no need to submit the Iowa 100 for that year because you're not taking a capital gain deduction.
Gotcha. There was one, I think we were talking about some different things with signatures. Does the tax preparer still need to sign the return if a computer program is entering the name?
You need to have some sort of way of authenticating the taxpayer signature. We follow the federal rules in that regard. So there needs to be some way to verify the identity of that tax payer. And again, we follow the federal electronic signature rules. So,
okay. So electronic signature rules is the answer there. Let's see. Sophie, can you grab that link from Carly in the Q&A and put it in the chat for us on the fraud and identity theft piece? We can answer that question. We got quite a few rolling still here through. We're just about out of time. Let's see. I'll see if we can't find one more in there. Let's see. And Kurt, if you have it up to, here's one. So sticking with that capital gains theme, capital gain would not apply to a second home sold and never used for a rental. Would capital gain not apply to a second home that was sold that was never used for a rental? There's
For
maybe some more
the-
specific, maybe there's more specifics there that we would need to be able to answer that question fully
Yeah,
accurately, but
Yeah, a lot of that's going to come down to the material participation. If I had a rental home and I didn't really have any participation in it, I just had a tenant in there and I collected rents. I didn't perform any maintenance. The tenant did that. I may not qualify. I might not have enough hours in there, or I might not meet the threshold for material participation for this purpose. It seems like every situation has to be looked at individually to see whether you meet one of those thresholds identified in Administrative Code Section 4038. So just by saying I've got a rental house doesn't mean that you do or do not qualify. You need to prove that you materially participated in that business, I'll call it.
gotcha. All right, well, puts us pretty much out of time for today. Kurt, again, thank you so much for being on this webinar with Iowa SourceLink. Again, look at that link for December 8th. There are questions in Q&A that we didn't get answered. So those will be ideally sent over to the department and maybe can be used to literature, or if you do have direct questions that didn't get answered, please send them in directly to Kurt, his email, or wherever you think they should go at the department. It was in the slides there, that we can make sure we get your questions answered. So with that, everyone, thank you so much again for attending, and hopefully you have a great rest of your November. Kurt, thanks again.
Thank you.